This video is going to cover the topic of the audit report. The audit report is the final report at the end of the audit process that is communicated to management and the shareholders of the entity. It is within the audit report that the independent audit opinion is shown. In this video, we will be covering the following topics: regulations surrounding the audit report, the contents of the report, forming an opinion, and communicating to those charged with governance. The audit report is regulated by auditing standards. ISA 700 Revised is the standard that informs us of the objectives and format within the report. The standard states that the objectives of an auditor are to form an opinion on the financial statements based on the conclusions made from the evidence collected, and to express their opinion clearly through a written report. When the auditor forms the opinion that the financial statements are true and fair and properly prepared, they issue an unmodified opinion. If there are no issues to draw attention to for the users, the audit report will be referred to as an unmodified audit report. The contents of an audit report are laid out in the standard. This is based on an unmodified audit report where there are no material misstatements and no issues unresolved during the audit. Within this audit report, there should always be the title, clearly showing that this is an independent auditor's report, the addressee, showing the intended users of the audit report. The audit opinion is included underneath, where they will state that the financial statements give a true and fair view. Basis for opinion, which explains the professional standards used when reaching the opinion shown above. This helps give confidence to the users and includes more details on the opinion given if necessary. Key audit matters is next. This section will highlight any of the important matters that have been dealt with during the course of the audit. Its purpose is to highlight significant areas to the users to help with decision making. This is compulsory for listed companies and can be included for non-listed as it is best practice. Other information explains the management are responsible for the preparation of the other information, which may be published with the financial statements. An example would be the director's report. Remember that the auditors only review the other information submitted for any inconsistencies with the financial statements, and therefore do not audit and form an opinion on this area. Management responsibilities is shown as a paragraph explaining the key responsibilities of management during the audit process. Remember, they must prepare financial statements free from material misstatements, using good control systems in accordance with relevant accounting standards. Auditors' responsibilities are also included in a paragraph, explaining that they must form an opinion on the financial statements based on sufficient appropriate evidence collected through audit procedures. The audit was conducted in accordance with ISAs, and the audit was planned and performed to provide reasonable assurance on whether the financial statements are free from material misstatement. Other reporting responsibilities would be included underneath this, if there are other responsibilities to report under local legislation and regulations. Finally, at the very end would be the engagement partner's name, signature, and address of the audit firm carrying out the audit and the date the audit report was signed. We have now seen what would be included in an audit report if the auditors conclude that the financial statements are true and fair. However, when concluding an audit, it may not always be appropriate to state this, and there may be complications that need to be communicated. The forming of the audit opinion is usually made by the audit or engagement partner, based on all of the evidence collected and discussions made with the audit team and the client. The format of the audit report may therefore change depending on what they conclude. The audit partner initially needs to decide whether the financial statements are true and fair. That will be a simple yes or no. If it's a yes, then as we've mentioned before, with no unresolved issues and the financial statements being true and fair, then the audit report is unmodified with an unmodified audit opinion. Another term you may see used is an unqualified opinion, and this is just another term for an unmodified opinion. Okay, going back to the audit partner. What happens if the audit firm have concluded that the financial statements are not true and fair? Well, next they need to ask themselves why. It will either be because there is a material misstatement still within the financial statements, or there is a lack of sufficient appropriate evidence obtained during the audit process. For each of these issues, the auditor must modify the audit report with what we call a qualified opinion. The auditor then needs to decide whether the matter is material or material and pervasive. Material means the matter is important to the users. This is based on the auditor's judgment, referring also to the guidelines given on materiality. For example, an item is material if it is greater than 5 to 10% of profit, 0.5 to 1% of revenue, or 1 to 2% of total assets. Material and pervasive means the matter is very significant to the users. In simple terms, it means the matter is so fundamental it makes the financial statements unreliable. Focusing on if there is a material misstatement. If the matter is concluded as material, the auditor must modify the audit report. Remember, the standard audit report is an unmodified one, and so if the opinion wording needs to change, the auditor is modifying the audit report. The audit opinion for a material misstatement would state that the financial statements are true and fair except for the matter that was not corrected. This is known as an except for opinion. To give you an example, let's say the auditor discovered a receivable customer was unable to pay the client, but the client refused to write off the debt. If the debt was 20% of profit and the customer can clearly not pay, it would be a material misstatement as the client has not followed the correct accounting treatment. If the client refuses to amend the financial statements, the auditor must modify the audit report with a qualified opinion due to a material misstatement. As it's material, the opinion is an except for opinion. If the matter is material and pervasive, as we've said before, this will mean that the financial statements as a whole are unreliable. The auditor must modify the audit report, but this time the wording in the opinion section will state that the financial statements as a whole are not true and fair. This is known as an adverse opinion. An example would be if the client had not presented the financial statements using the correct going concern basis. If the directors had produced the accounts using the going concern basis on the assumption that they could continue in the foreseeable future, but the auditors did not believe this to be realistic, the accounts could be seriously misleading to the users. If not resolved, the auditors would disagree with the accounting treatment and so modify the audit report with a qualified opinion. The matter is material and pervasive, and so an adverse opinion would be included, stating the financial statements are not true and fair. Going back to deciding whether the accounts are not true and fair, this time let's look at the types of opinion if it's due to a lack of sufficient and appropriate evidence. Once again, the auditor needs to decide whether the matter is material or material and pervasive. If material, the auditor must modify the audit opinion. Similarly to our material misstatement, the wording will indicate the impact of the lack of evidence, making it clear the lack of evidence is in isolation. The opinion will once again be an except for opinion. An example would be if the client did not perform an end-of-year inventory count. If the auditor attends, they are able to verify the existence of inventory. If existence cannot be verified by other methods, there is a lack of sufficient and appropriate evidence in this matter in isolation. If evidence can be obtained in all other matters, then the audit report will be modified with a qualified opinion due to a lack of sufficient and appropriate evidence. The matter is material, and so an except for opinion is included. If the lack of sufficient appropriate evidence is material and pervasive, then the auditor has a dilemma. Without enough quality evidence, they will not have the confidence to provide reasonable assurance on the financial statements. The auditor will modify the audit report with a disclaimer. The disclaimer will state that they were unable to form an opinion. An example would be if the client has refused to give any written representations to the auditor. These must be obtained as evidence and must confirm matters such as that the financial statements are free from material misstatement, events have been disclosed correctly, and all books and records have been provided to the audit team. Without such confirmations, the auditor will not have the confidence to provide reasonable assurance on the accounts. If the directors cannot be persuaded to provide a written representation, the auditors would have no choice but to modify the audit report with a disclaimer. So far, we've established that if the financial statements are true and fair, the audit report will be unmodified with an unqualified opinion. If the financial statements are not true and fair, whether it be due to a material misstatement or a lack of sufficient appropriate evidence, the auditor must modify the audit report with a qualified opinion. They then need to decide whether the matter is material or material and pervasive to conclude the wording within the opinion section. There is one more type of audit report modification we must conclude with. The final scenario is if the auditor has concluded the financial statements are true and fair, but there is something of fundamental importance within the financial statements that the auditor wishes to identify. There are three scenarios. The first is if there are concerns over the client's ability to continue in the foreseeable future. If this has been disclosed adequately in the financial statements, then the auditor will highlight this important issue in the audit report. This will be shown under the heading Material Uncertainties Relating to Going Concern. Another paragraph that may be included is an emphasis of matter paragraph. This paragraph will highlight something that has been included in the financial statements, but is of significant importance to the users. This could be, for example, a large provision and disclosure for an ongoing court case. The other would be a section headed Other Matters. This would include anything else that is of importance in understanding the entity and the financial statements. For each of these sections, the issue will be included in the financial statements and therefore they are only present to draw attention to the matter. Communication to those charged with governance is outlined in ISA 260 and ISA 265, where it highlights the formal communication of issues between the client and the auditors. The first formal communication is the engagement letter, where the agreement of responsibilities and the outline of the auditor's role is documented and signed. The next formal communication is the management letter, where any issues found, including deficiencies in control systems, are documented. Any recommendations are also included in this report and usually communicated at the very end of the audit process. The audit report, as we have now seen in this video, outlines the overall independent opinion made on the financial statements. This report is included with the finalised accounts and presented at the AGM for the shareholders to review. If there are potential modifications to the audit report, these should be discussed as soon as possible with the client before the audit report is signed. I hope you found this video useful. Thank you for watching.